Welcome to the Weno trading floor. A huge thanks to Weno for being major sponsors of FinFest. Thanks, mate. Thank you very much. After 3 years of upheaval and volatility, what does 2023 have in store for markets? Has inflation truly peaked? How far will interest rates rise and property prices fall? Is a recession coming? James Holt, Director, Investment Solutions at Perpetual, will look at the top 10 things that should be on investors' minds as the new year fast approaches. Without further ado, please make James feel very welcome. James.
Thank you. Well, that's all we've got time for. No kidding, obviously, but quite wonderful to have you here. Isn't it a great event? I haven't done this for a while. I'll be spinning in circles, so hopefully I won't fall over by the end. They had to discourage slides today, so I thought I'd just jot a few points on my phone in case I have a senior moment up here. But look, I think the first of the 10 things I was going to talk through, and they sort of interrelate quite a bit, but the first thing for me really is the risk of a policy error at some point over 2023. Let's face it, I don't think our central bankers have necessarily done a great job. They weren't meant to create this inflation. They have created a lot of inflation. They weren't going to raise rates until 2024. They then did it 2 years early. A lot of mistakes have been made, although as Will Rogers said in America, if stupidity can get us into this, surely stupidity can get us out of it as well. So we'll see what other mistakes are made over the course of 2023. I think, frankly, there'll be a few. The truth is that in the United States, they've had about 12 tightening cycles in the past 50, 60 decades. They've managed to avoid a recession 3 times, 1965, 1984, and 1997. They avoided a recession until 4 years later. It's not a great record. You wouldn't go on the operating table if the surgeon had a 30% chance of success, right? But that's the most likely outcome, I think, in 2023. So I think that's the biggest challenge we face. Those numbers not that great, and that'll be a problem for next year. So look, my expectation is there will be a recession next year. I think that's odds on, certainly in the United States, certainly in Europe as well. Here, it's a bit of a different story. It could be that we avoid it. Either way, I think when your house price is down 15 or 20%, which looks like it'll happen, when jobs get a bit tighter next year, when consumers go through a bit of a slump, having had all this stimulus heading their way for the past few years, and someone pops up on the nightly news and says, actually, technically we haven't had a recession, I don't think that's how people will feel, right? So it'll feel like it or actually be it one way or the other. The tricky question is, we normally only get a recession every 7 to 10 years. We avoided them for 30 years, but in most parts of the world, they get them every 7 to 10 years. Now, we have had a recession 2 years ago. It looks like there'll be one next year. The problem is, we should have probably had a recession 2 years ago. It should have been a corporate recession in the United States. That's what we were due for. We wouldn't have then had another recession for probably 7 years in the latter end of this decade. So the trick is, are we going to get a little bit of a corporate style recession we should have had 2 years ago, which is okay for consumers, but pretty bad for companies? Or are we going to end up sliding into a sort of a bigger consumer recession, GFC Mark II, which is due in about 2 to 3 years' time? I think, in fact, it's too early for that, and it'll be a reasonable recession, but we'll get over it pretty quickly. Our base case is we head into recession, we bounce out of it pretty well. We're invested both ways, which I'll come through towards the end of the presentation. So we're right in between those two. And although the central banks will take care of inflation to a significant degree, I don't think they'll completely solve it. I think we're stuck with inflation for some time to come. Repeatedly, people have said we're past peak. How many times have you heard that said we're past peak inflation? All this year, every time a monthly inflation report comes out in the US, we're past peak inflation. We're not. The latest one is rent of shelter, which is 30% of the CPI. That's now heading up in the US. That might head up for the next year. And of course, just when the oil price finally drops, what does OPEC do? They constrain supply and oil prices heading back up as well. So I think inflation is going to be stickier than normal for those factors, but also because of deglobalisation. We've had a tremendous multi-decade period since World War II in which we've outsourced everything, goods have got cheaper, we've imported from around the world. Those days are going for the time being. They will come back eventually, but the last time we had a deglobalisation period, it lasted 30 years, from 1914 to 1945. Let's hope it doesn't last that long, but I don't think America and China are going to kiss and make up anytime soon. Let's face it, that relationship is pretty impaired for the time being. So there'll be more, we used to manufacture for just-in-time manufacturing. We manufacture overseas, bring it here, arrives just in time to sell in the shops. We're no longer getting just-in-time manufacturing, we're getting just-in-case manufacturing, built here at home, more expensively than before, but it's more reliable. You'll see more and more of that. These things don't move from one side 100% to the other, but you get bits and pieces of these things in effect, and that'll put upward pressure on prices for some time to come. So deglobalisation is a big thing. Decarbonisation, I think it's a good goal, but believe me, it will cost us. The next 8 years, for example, we'll need to spend the equivalent, we'll need to build the equivalent of the last 30 years of infrastructure and energy 3 times over. Okay, it's a lot of investment. I think ultimately it'll be a good thing. If we spread it over 30 years, there'll be less pressure. If we really try and accelerate over 10 years, there'll be more upward pressure. I've got no problem with it at all. I think it's a good thing generally, but there will be probably a price to pay for it. I think that's the price you pay for cleaning up the planet to a degree. But it also means, again, it's just another contributing factor to inflation. And demographics. The IMF has modelled this. If you want to read a good book on it, look at The Great Demographic Reversal by Charles Goodhart and Manoj Pradhan. They've written about the fact that ageing, in fact, when we're young, we add to inflation. When we're older, we add to inflation. And we're going into a world where there's going to be a lot of older people consuming healthcare and things like that. The bond vigilantes are back. Look at Liz Truss in the United Kingdom. Came into office, first thing she tried to do was cut taxes, and what happened? It's blown up completely. She fired the Treasurer last night, the Chancellor of the Exchequer after 6 weeks. That didn't go well. The Daily Star has put out an article today saying they bought a lettuce and they said, what's going to last longer, Liz Truss's Prime Ministership or this lettuce? I think she's in big trouble. I think she could be gone in a very, very short period of time. But it shows that governments are not in control of finances like they used to be. The markets are telling them what to do. James Carville, Bill Clinton's advisor, famously said in the 1990s, when he dies, he wants to be reincarnated as the bond market because he can rule the world. I think the bond market just reminded the UK government that you think you're in control, but if we don't like it and bond markets arc up, they can actually wipe out a government pretty quickly. That government looks unelectable to me now because of a decision they made without actually sort of testing the waters to see how the markets would take it. Long way to go, clearly, but I think there's all sorts of trouble there potentially to come. Also, I just think the UK is the first of a wave of this sort of activity. I don't know if anyone's been watching it, but the figure I keep a track of in the US, I think is the most important, is the 30-year fixed mortgage rate. It comes out every week on a Thursday, the average, and it hit 6.92% on Thursday night. Now that is the highest in 20 years. Now, we talk about the markets and how much of an effect they have on day-to-day activity. Most of it is just noise. But when the activity hits mortgage markets, the way it's hitting the US and it's hitting mortgage markets here, and the way that Truss's attempted a tax cut in the UK basically blew up the UK bond market and caused banks to withdraw loans from shelves, that's when people notice. And that's the process we're going through right now. The fourth or fifth factor, I think zombie companies are going to have a terrible time next year. Now, as a rule, we screen out about a third of companies. We look at about 450 companies. We immediately remove 170. Why? Too much debt, don't make enough money. We will miss companies. We'll miss a few firecracker companies that rise very quickly, but we avoid the zombie blow-ups. And they come every 5 to 10 years. And we think they're due. We're due for a few of those zombies to go broke. We can't pick exactly who it's going to be, but I guarantee you they're the ones that don't make money and the ones that have too much debt and don't have good management and a product that just won't last the distance. If you can't make money when interest rates are high, you could never make money. It was a fake business model. It just got a temporary pass until the markets sort of figured it out. The risk of some sort of crisis next year is reasonable. I think it's on the rise. The simple reason being, the Fed has tightened policy in a way we haven't seen for 40 years. Interest rates are rising very rapidly here at home as well. We have not raised rates this rapidly, the delta of interest rate rises, in the modern economy. when we last raised rates like this in the early 80s, we hardly had any derivatives. The financial system was tiny by comparison with today. So I think the effect of a rapid rise in rates on the financial system is unknown. I think that does present a few risks that might pop up. And that's why I said before, the UK, I think that it's the first one to drop before we see a few of these, a few countries, companies, and potential industries to get into some sort of trouble. And it happens all the time. We had the Mexican crisis, we had the Asian crisis 25 years ago, it's subprime. I don't think it's a subprime level thing, but I think a few corporates might find themselves into some trouble. Remember Greensill? I think there'll be a few Greensills out there by the time we get to the end of all this. And also, it's not just bond markets reflecting this stress, but currencies. The pound at 37-year lows. The pound's been going down for 500 years. But it's got to exceptionally low levels, and again the yen is about 24-year lows, which I think marks for a bit of stress as well. So also potentially, geopolitics, that's one of the risk factors for next year. I don't think, people talk about Taiwan and China, I don't think necessarily that's going to happen. I think it's pretty crazy if you invade Taiwan, for the simple fact that Taiwan Semiconductor, which is the most important company in the world arguably, would cease production of chips, and Taiwan Semiconductor needs real-time interface with other companies around the world to produce those chips, and if they disappear, nothing's going to work in China or America. That's why I think the risk of an invasion there is quite low, but there might be some attempt to try and circle the island, who knows. I think that's all coming over the next few years. They'll aggressively try and encourage them to become part of China again, but we wait and see what actually occurs. I think a far bigger risk for 2023 is that our friend Vladimir just gets very, very desperate and does something just to push the edge. He's the master chess player, and there's a risk of that, and I think it's worthwhile having a bit of gold in your portfolio. Gold's done terribly because this hasn't been a crisis, but if there is a crisis, you want to have a little bit of gold in your portfolio, I think, for that reason. Interestingly, Kevin Rudd, who is a great China analyst, has said that if Putin goes, Xi Jinping might have to go as well. I thought that was an interesting point to make, but we'll wait and see what happens. But I don't think there's going to be a serious problem there. I think Russia's where the risk is, not necessarily in Taiwan. Look, the biggest mistake people make, I think, is staying out of the market. Far more wealth long-term has been lost not being in the market than being in the market. How many times has cash gone down, ever? Never. It's the only asset class that's never gone down. Yet it's always got the wooden spoon. It's the last asset class over any time period you look at. And if you go through the numbers, you do it year by year, I've done this several times, you find it's the lowest performing asset class more often than anyone else. That's the challenge. So I think as risk averse people, we want to be not invested often, but it's actually the biggest long-term risk. Tactically, cash makes sense from time to time. But if you keep a permanent allocation in cash, especially during periods like now, it just gets inflated away. And great fortunes have been inflated away over many, many periods of time. The great way to make a small fortune in an inflationary period is to start with a large one in cash, and it'll be gone. So we need to be invested. What we're thinking about though is you want to be invested for protection in case those storms come. Equities always bottom before the recession. So forget about trying to pick the recession next year if you think it's going to happen. The equity market will bottom and moved on before the recession is ever declared. That's a simple fact. 9 times out of 10, that's what happens. Only once or twice it's bottomed afterwards. So I'd be prepared for that. We think earnings downgrades are coming, but there's a lot of great places you can have your money, we think, that's a pretty safe port. Companies are trading at record lows, cyclical lows, that do better as interest rates rise. IAG, I know it's out of favour. IAG used to be $8 a share, it's now $4 a share. It does better when it's going through profit upgrades. At the moment, in rainy weather, more people have car accidents, there's more claims. There's more claims during wet weather than dry weather. Now, IAG are pushing up its premiums, but its claims are going up as well. When eventually we get to dry weather, within 6 months, 12 months, whenever, the claims go down, but the premiums stay up and the profit improves, and that's when IAG tends to recover. So you want to buy these things, in our view, we do them in our portfolio when they're on their back, when they're going begging. That's the opportunity to buy. La Française du jour. Nobody's ever heard of it. It's the French lottery. You want to own lotteries. You want to own companies that have monopolies on certain things. They're they've got a monopoly in France. They're rolling that out from newsagents to online. They're getting better margins as they move online. It's a great business. Newcrest is our gold pick for the time being. They're the sort of things you want that stabilises in your portfolio. But we think there's great cyclical upside as we move through 2023 in a lot of resource names, and we think they'll do well over quite a long period of time. There's big shortages eventually in things like copper, those sort of commodities which are needed for electric vehicles. So think about Santos is one we own, gas. We think Santos is a very critical transitional energy. We cannot go from fossil fuel to 100% renewables. It is not possible. We have to transition over many decades through gas. We think Santos is the best place to play for that. We will switch off coal more and more, but we'll move it to gas. That's for sure. Jervois, we own that for cobalt. Cobalt is dug up in some unattractive parts of the world. Jervois have a mine in the United States, which is more attractive. And also what you'll find is the American, Australian governments and others are very keen for these sort of resources to be mined in parts of the world where they can get access to them in case the situation deteriorates. So Jervois, cobalt in the US, Iluka has been given a loan by the government, $1.5 billion, to develop rare earths, because all of the rare earths come out of China, but you need rare earths in virtually everything electronic these days. So those rare earths are very important. We own Iluka. It also is the biggest producer of rutile, zircon, things like that, but rare earths as well. And also stocks like Mirvac, they've come down a long way. Trades below $2, it has assets closer to $3. Yes, there will be a correction in property, but it's unlikely that that gap will be bridged. A high quality company like that, we think, is a very attractive place to be. And lastly, as I said before, it's critical to be diversified. Cash is not going to help you in the long term. We think that's a pretty important thing to bear in mind, and you've ultimately got to be invested. I'll leave you with the Kerry Packer, when he passed, Kerry Packer's father, when he passed away, Sir Frank, left basically a very similar amount of money to Kerry and his brother, Clyde Packer. Does anyone know about Clyde Packer and Kerry Packer? Now, when they died, how much money did Kerry Packer have? $3-4 billion, I can't remember, it was many billions, 8 billion maybe. How much did Clyde have? About $10 million. Now, that's the sliding door of investing, in my view. Clyde sold to his brother and moved offshore and lived a great life on $10 million, which is a lot of money in 1974, but it wasn't much money by the time he passed away. And I'm just saying, all I'm saying is, and I can't remember what he used that money for, primarily lifestyle, I think, but the point is, you can have these extreme outcomes because one has invested and bought into industries that do well over time. One has basically had the Playboy lifestyle, and the difference is basically thousands to one in terms of the outcome. And that's the cost, in my mind, of cash and you never see a billionaire who's saved his way to success, held cash that whole time. So I think that's quite critical in terms of making sure you avoid the worst of these inflationary periods and you sort of grow your wealth carefully over time the way we like to. Thank you very much for your time. I think we're full time, but we're obviously at the front of the block here as well, the perpetual tents, so feel free to come by if you haven't already. I'm more than happy to chat to you.
Equity mind.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.